All right, good morning, everybody. Today's trading lesson is called Amateur Hour. We are going to be discussing some common mistakes people make that prevents them from being successful. All right, so the first thing I would say most amateurs have trouble with or make mistakes about is they believe that everything that the news media is speaking about is actually true. They believe that, if the media says, well, the market's down due to trade wars or the market's down due to the Turkish lira, that's really what's the cause. But that's actually not the cause at all. 99% of the time, the market's moving has nothing to do whatsoever with what they're talking about on television. We'll cover that in a little bit. So the second mistake I see people make, and these aren't really in any kind of order necessarily, but the second mistake that people have, or amateur traders, is they think that the great traders of the world have some kind of secret system, some kind of holy grail, if you will, of methodology that's always correct. For instance, one time I heard someone say that Steve Cohen of SAC was only successful because he used DeMark indicators, which begs the question: well, then why isn't everyone that successful? Because they could just go out and buy the same book. But there is a holy grail, and the holy grail is understanding risk management and investment psychology. And this is something that retail traders or unsuccessful traders ignore. And sorry for the terminology, retail trader versus an institutional trader. This is just for traders that aren't successful. I guess they could be either. So here's an important point that we're going to cover in a few minutes in more detail. We unsuccessful traders think that what they buy is more important than knowing how to sell it. So we always hear people say, oh, I just bought this, I just bought that, but no one ever says, well, I bought XYZ at 20, and if it gets to 25, I'm going to sell it for a profit, and if it gets to 19, I'm going to sell it for a loss. So you have to understand that knowing how you're going to exit a position is more important than knowing what position to get into. Another problem that unsuccessful traders have is they try to catch the exact bottom or top. And if you don't have rules, this is really just guessing. All right, so this is like I said, in my opinion, about 99% of market moves have nothing to do with what the media is talking about. We have to remember that the business model of most modern media is entertainment, not journalism. Markets move because of the underlying trends that are occurring and how they react when they reach levels that are important. There are levels in the market that are more important than other levels with regards to the amount of supply and demand that exists at them. In addition, prices are always doing one of three things. They're either going up, going down, or staying the same. So they're always trending. Now, here's the thing. If something is trending lower and it gets oversold and it gets to an important support level, it's probably going to rebound. Okay, it's probably going to bounce. And if you look at my other trading lessons, I cover that in more detail. But the point is whatever the news story du jour is that day, the media would attribute that bounce to whatever. Turkish lira, interest rates, China, FANG stocks. I mean, who the hell knows? But the point is that it was bouncing because it was oversold and it hit a support level. It has nothing to do with whatever the fundamental news that day is. Markets also move due to noise. Okay, there's always things going on. There's always clients withdrawing money, adding money. Now consider this situation. A client of a mutual fund wants to withdraw $100,000. Well, then the traders at that mutual fund need to sell a basket of the stocks that are in that fund that are worth $100,000 to raise cash for the withdrawal. On the same day, a different client deposits $200,000 into the same fund. So now the traders need to invest this money, and they're literally going to go out into the market and buy the same stocks that they're selling. You might say, well, why don't they just shift the shares from one account to another? But that just is not that's not legal. It has to go through a broker. So in a situation like this, and assuming that this money needs to get invested by the end of the day, that's going to create noise. If at the end of the day, all $100,000, the sell was completed, but there's still $50,000 left to buy at the end of the day, and they have to get it done, well, that's going to make the stocks move up. Now, this has nothing to do with fundamentals. There's nothing to do with what the media is talking about. It's just basic noise in the market. Now, consider the fact that this happens tens of thousands, if not hundreds of thousands of times every day, then that causes the noise that moves the market. So what moves the market is noise, like I just discussed, the underlying trends, and trends are fractal. In other words, there's short trends, medium trends, long-term trends. That's what makes the market move, how the market reacts to different levels and so forth. So now I just wanted to point this out because it's kind of funny. Here are two recent examples of fake financial news. And if you follow the markets, which I presume you do, which is why you're listening to me, you're well aware of all the news hysteria, what I call hysteria, this past summer and over the past few weeks about the trade wars and the devaluation of the Turkish lira. All right, so I just did a quick Google search, and this is when I first heard the Turkish lira news, so from August 17th. So we'll just look at some of these things. Turkish lira, currency crisis not over, could hit 8 against U.S. Could Turkey's financial crisis have a snowball effect on world markets? Stocks falter as lira wobbles. Currency market turmoil. Trade tension to sway market during the week ahead. Turkey lira crisis. 6 things you need to know. All right, so fortunately, the world withstood this catastrophe, but we will go now. This trade war. I mean, people have been talking about the trade war for a while, but I think it really hit the news right around July 6th. So I did a quick Google search, and here are some headlines. Welcome to your trade war world. It could get uglier, so hang on tight, according to Bloomberg. New York Times, biggest trade war in economic history is playing out. Trade war begins. U.S. and China exchange $34 billion in tariffs. We are forced to retaliate, China says. And then from the agricultural world, China trade war hits agriculture harder starting July 6th. All right, so pretty bad stuff, right? So now here is the S&P, or well, these are the SPYs, which follow the S&P 500. And I have left the dates off. Okay. See down here, there's no dates. All right. Now, if you were going to look at this chart, can you identify what day July 6th is? Can you identify what day August 17th was? I mean, if you're thinking, well, gee, that sounds like pretty big economic calamity, I guess maybe that would be one of them. You know, the market was down, maybe 30, 40 basis points, maybe down here. I don't know. All right, so guess what? This was July 6th. All right, it looks like a pretty strong day to me. Market had a nice move up, took out the short-term support or resistance level. Oh, and look, here's the Turkish lira crisis. All right, strong day. Market actually gapped up the next morning. So you can see that these calamitous events that the media was talking about were pretty ridiculous. I mean, I even saw some well-known Trump hater on TV, and not to get into politics because I'm an independent, but this person was saying, oh, Trump this, Trump's evil. Look at what his trade war policy is doing to the market. It's like, what the hell are you talking about? The market's at an all-time high. The market's been doing great. And I saw Ken Fisher, who is the money manager out of Washington, who knows a hell of a lot more than I do, saying that trade wars were very bullish. So I don't know what exactly his reasoning was, but I think the market tends to agree with him. All right, so this is what I was saying before. Retail traders think that the great traders and hedge fund managers have some kind of secret method or secret system that they use, some kind of moving average thing or this or that or the other thing. But people would be very surprised to find out that the best institutional traders are correct only 58% of the time. The difference is they let their winners run and they close out of their losers. And in theory, right, you could be right 1 in 10 times. If you cut all 9 of your losses very short and you let that one winner run, you could come out ahead. I mean, that's essentially what venture capital funds do. They might invest in 20 businesses hoping that 2 of them work, and the gains will outweigh all the other losses. So there have been some systems that have been exceptionally successful. For instance, if you read that book Dark Pools, it talks about the rise of the high frequency trading industry. And there were some funds that were literally making money every day to the point where they would shut stuff off to make sure that everything was correct. But on Wall Street, like in other places, competition saw how successful they were, and it came in. And now a lot of these high frequency funds are either going under, or they're not making money, or they're just making money selling their order flow. And what that means is there's this thing called maker taker, and these funds that trade billions of shares or millions of shares can go to an exchange, and an exchange will say, all right, if you post liquidity on our exchange, we will give you a rebate. If you take liquidity off of our exchange, we will charge you a fee. Now, what that means is, say you want to buy 100 shares of Apple computer. If you go to an exchange and you take the offer, that's taking liquidity off the exchange. So you would have to be charged a fee for that if you were a broker. Say you went to that same exchange and instead of taking an offer, you posted a bid. That's adding liquidity to the exchange. So you would get a rebate for that. So some of these funds trade so much that they're losing money on their trading, but they're making money on this whole maker-taker thing. There's questionable ethics there, in my opinion, but that's not a discussion for today. So anyway, so there is a holy grail, believe it or not, and that's risk management and proper psychology. So all the great traders know this, and we'll talk a little bit more about it. All right, so very important, this page, because like I said, the holy grail to successful trading or investing is risk management and psychology. And it's very hard for people to do because people have not evolved in a way that's good for managing money, right? When you enter a trade, you might get fear, which triggers a fight or flight response. And that means your adrenaline gets pumping. And that's not a good thing for trading. Might have been a good thing 20,000 years ago if you're hunting a woolly mammoth or a saber-toothed tiger, but it makes people make illogical decisions. And that's one of the reasons why there's been such great success over the last, 15 or 20 years in quantitative funds, because quantitative funds don't have emotions. One of the main problems that unsuccessful traders have is they close out their winners too soon and they hold on to their losers for too long. This really, in my opinion, just comes from a desire to want to be correct, to prove to yourself that you're smart. Because if you're closing out of your winners too soon, it means you didn't have a exit price in mind. And if you're holding your losers for too long, it's because you didn't have a stop out involved. And when you enter a trade, you should always know where these two sell, or, assuming you're not short, just pretend for hypothetical sake you're long, you should always know where your two sells are going to be. So successful traders are aware of this, and they think about perception biases, and they act accordingly. And what's a perception bias? Well, put it this way. I'm a big sports fan, and yesterday was Sunday, so football was on. Now, you could like a certain team, and you go into a restaurant or a bar, and there's another person there wearing a jersey of the same team that you like. All of a sudden, you feel like some kind of a bond with them, right? But it's like you don't know that person. They could be an axe murderer. You just have a bond with the shirt, in essence, because that goes back to, I guess, tribal things in evolution. And that's a perception bias. But you just have to be aware that humans have not evolved. And when we get involved in trading, it causes us to have these emotions that are very detrimental to success. Now, you also have to have an understanding of position sizing. And what does this mean? Well, this has to do with the risk that you're taking on with each trade. For instance, say you buy a $10,000 option position that could expire worthless. You could lose $10,000. Say you put $100,000 into a stock and you have your stop out at 90 or 90% of where you bought it, say it's down 10%. So in other words, on your $100,000 investment, you could lose $10,000. So from a risk point of view, both these trades have the same risk because you could lose the same amount of money, even though one of them is using 10 times more capital than the other one. So I guess this is the bottom line here, is that successful traders understand risk and they utilize risk management. And you can have a lot of different strategies. There's no one strategy that works. If you could have moving average crossover systems, you could have trend line breaks like I do. The point is you just have to have something. You can't just guess. All right, now this is important. All these are kind of important, and they're not really separate. They're all these mistakes are kind of all part of the symptoms of the same shortcomings, if you will. So successful traders have rules. They don't get trade-off tips that they get from their buddies or in chat rooms. And they think that unsuccessful traders think that what you buy is more important than knowing how to sell it. So like I said before, you always hear people say, well, I just bought this, I just bought that. In reality, not even just in theory, in reality, you don't even need to know what you're buying. You could just pick a random stock out of the newspaper. And if you have a proper sell target and a proper stop out, you could end up making money. Just pick 10 random stocks and have that strategy on it, and you could make you could be profitable. And that's what some of these quantitative funds do. They don't care. Well, most of them don't care what industries these companies are in or what they do. They just look for volatility and levels. And so this is I think the most important lesson in trading is that when you get into a position, you need to know where you're going to be stopped at, and you need to know where you're going to take your profits. And if you don't know this when you enter a trade or say you buy a stock, then you're just guessing. You should not enter a trade unless you know where and how you will get out of it. Very important. Go into it with a defensive mindset. Don't just buy it and then just hope it goes your way, because then you're just guessing. And if you don't have an exit plan, that's going to lead people to close out of their winners too early and hold on to their losers too long. If you buy something at 20 and you say, I'm going to get stopped out at 19 and I'm going to sell it at 25 for my profit, and then say you use a trailing stop and it goes to say 22 and your stop goes to 21, then it goes to 23 and your stop goes to 22. All right. If you have a plan like that and well-defined rules, then that's going to prevent you from just being like, gee, I don't know what to do, but you have that human desire to prove that you're correct, and you just go ahead and close it out too early. So you buy it at 20, you sell it at 21, only to watch it then go to 25. Sound familiar? I know it does for me. I used to have that problem. That was my biggest problem with trading, is I just close out of stuff too soon. So I don't really do that as much anymore, but I'm still susceptible to that because I'm still a human. All right, so number 5 is unsuccessful traders try to catch the exact bottom or top. Successful traders have plans and rules. That's going to define how they enter and exit trades. If you don't have a plan, you're just guessing. I mean, face it. If you don't have a plan, you're just guessing. You don't want to do things on intuition, what some idiot on the news says, what your buddy at the club tells you. So what I say here is if you don't have a plan, you're just guessing, go to the casino because at least you get free drinks instead of having to pay for the drinks after you just got run over and lost a lot of money because you're not following your rules. So I believe that the desire to get the exact bottom or top is driven more by emotional need to prove smartness than by logic. It's just not a logical thing to do. Of course, if your rule says, all right, well, I'm going to buy something when it's down 20% off of its 200-day moving average, and that just happens to be the exact bottom, well, great. But you're not guessing. You're buying it because you had a rule. All right, so in conclusion, If you want to improve your trading, understand that you have not evolved in a way that's good for trading, and that'll give you an awareness of your emotions. Understand that if you have a fight or flight response triggered, that's going to make you make irrational decisions. Adrenaline might be good if you're out on the hunt, but it's not good for trading. The desire to be correct causes traders to close out other winners too soon and hold on to their losers too long. So that's another thing. Say you enter a trade and you have a profit and then you want to close it out. You got to say to yourself, well, am I closing this out for a valid reason? Do I have a rule, or am I just want to get out of it so I can say, gee, I was correct, I made money, and then you sell it out and you watch the thing go higher. So here's the bottom line. Well, another bottom line. I guess there's been a few bottom lines in this presentation, but if you have rules, you're less likely to commit these errors. And like I said, your rules could vary. It could be I enter a position when the 50-day moving average crosses over the 200-day moving average. I enter a position if it's oversold and it reverts with a definable thing. For instance, it was outside of its Bollinger Band, now it's back in. So point is that there's plenty of systems that work if you stick to them. And that's why you need rules, and because it controls your human emotions, which are detrimental for trading. All right, well, thank you. Thanks for tuning in. Hopefully this will help you with your trading. It has with mine. Thank you.